Hello and welcome to this exclusive interview brought to you by Livewire Markets. My name's James Marley, I'm a co-founder of Livewire and I'm joined today by David Cassidy, who is the Head of Investment Strategy at Wilsons. Now David has the unenviable task of having to put together the full strategy, top down, understand all of the moving parts of the economy and think about how that might play out into the investment portfolios that Wilsons oversee. Obviously a big job, and with markets being at a really interesting point, we've got rates rising, we've got energy prices rallying. I thought it'd be a great time to get David in to come and have a chat to us about how he's seeing things and some of the views that he's got. David, great to have you in today, and welcome to Livewire.
Thank you.
First of all, tell us a little bit about yourself and about Wilsons and what the firm does.
Sure. Well, I head up the investment strategy group at Wilsons. So we set the investment strategy for the private wealth division of Wilsons. So we invest across asset classes. So part of our job is to set the strategic and tactical asset allocation for the private wealth business. We also select what we think are the best managers in each asset class. And finally, we also advise on direct investment, particularly into Australian equities. So we set Australian equity direct share portfolios. So we're trying to add value three ways: smart asset allocation, smart manager selection, and also at the stock specific level as well.
And Wilsons as a firm, can you just tell me a bit about the background?
Sure. Yeah, Wilsons has really got three businesses, but a fair bit of synergies there. So we've got the private wealth business that I spend most of my time working for. We have a stockbroking business, both obviously private wealth stockbroking, but also we have a institutional stockbroking business, which is primarily focused on small and mid-cap equities. So we have a fairly substantial research capacity in small and mid-caps. And thirdly, we have a corporate finance business. So that advises and IPOs, emerging companies. So I guess if you're thinking of it from a private client perspective, what you get from Wilsons is, hopefully a well-structured multi-asset portfolio. You get direct stock advice and model portfolios, but also the ability to access, interesting emerging company IPOs. So that's we think quite a nice mix.
If we're to talk about you for a moment, a really lengthy career with UBS, 14 years, and prior to that, JP Morgan. I wonder if you could tell me a little bit about some of the the investing lessons that you've picked up along the way and some of the things that you carry with you today when you're thinking about putting together investment strategy.
Yeah, I think I like to try and keep it pretty simple. So I guess pretty much focused on not getting too carried away with the noise. Obviously watch the markets very closely every day, every week, but don't really try not to get carried away with the excessive pessimism and optimism the markets can swing to from day to day, week to week. I think that's pretty obvious, but I think it's an important consideration to focus on the medium to long term. Why I'd like to stay diversified in terms of setting strategies. I'd probably stay on the optimistic side of the argument most of the time, within reason. Equities in particular, I think, have a history of going up more than they go down. Yep. So I think it's easy to get bearish when you're watching markets for a long time and looking at that wall of worry. But I think it's an important lesson to not get too bearish on markets. It's a time to get bearish, but for most of the time, I think it's good to stay relatively optimistic. I think the last 25 years or so, I think the general commentary has almost always been the markets look expensive, equities look expensive. That's been the case since the mid-90s. That's only really been right a couple of years out of the last 25. So from that perspective, I think it's a good lesson to not get overly bearish, but at the same time, stay diversified.
I guess that optimistic trend, we talk about markets look expensive right now is a classic example. We've got come out of a trough. Markets have rallied really well, and we're now talking about all-time highs for many markets again. And the backdrop is, for the first time, there really is some concern or evidence that rates might start to float higher or to push higher. So I'm keen to understand what your base case is on the outlook for inflation and how you're factoring that into the way that you're building portfolios.
Yeah, sure. I think, from that perspective, the bears would say, well, we've been spoilt for the last 25, 30, 40 years in terms of the inflation and interest rate backdrop, low inflation, continually falling interest rates. So it is a key question, rates finally going to move up decisively? Is inflation going to move up? I think firstly from the perspective of inflation, I am on the sort of transitory side of the argument. I don't really like that word, but I think it is a fairly good descriptor of what's going on to a certain degree at the moment. I think you can look at a lot of the inflation that's bubbled up in the last 6 months around the world, and you can make a pretty good argument that it is transitory to a degree. A lot of it does seem to be linked to the pandemic. There's a supply chain disruption. There's some very unusual swings in demand that have been caused by the closing down and opening up of economies. So I do think if we move forward a year, is inflation going to be higher or lower? I've got pretty high conviction it's going to be lower than it is at the moment. Yep. You've got US core inflation about 4%. I think it's going to be more like 3, possibly 2%. So I think it does come down. I think there's a little bit more of an argument about what's the trend rate of inflation. Has that shifted on a sort of a 3 to 5 year view? I do think it's possible that it is going to be higher than what we've been used to for the last 3, 5, 10 years. I do think the sheer size of the stimulus that's been put into economies everywhere, I think that does mean you'll probably get a bit more inflation over the medium term than we're used to. I think policymakers are just going to let economies run on the hot side over the next few years. So I think labour markets will tighten up. You've got energy markets that I think are going to be structurally tight. So I don't think there's a massive regime shift coming. And a lot of people are saying it's back to the 70s. I don't think that's the case, but I do think inflation will trend a little bit higher over the medium term. And therefore I think bond yields are going to prove to be too low. It's just a matter of how high and how quickly. I think it'll be moderate and gradual, but I don't like bonds at current levels.
Now, you mentioned just before that energy prices are one of the feeders into some of the inflation that we're seeing, and I know that you've put together quite a detailed report where you've gone and looked into what are some of the drivers of these higher energy prices that we've been talking about. I was wondering if you'd just take me through some of the key findings of that work that you did and what are some of the conclusions that you came to?
Yeah, sure. I think energy markets are interesting in that, unlike a lot of the other inflation pressures we're seeing at the moment, you can't really lay the blame on the pandemic to a large extent. I think there is some transitory factors in what's going on in some of these energy markets, particularly gas and thermal coal, but I'd almost call it more sort of episodic than transitory. I think there's been a lot of bad luck in terms of weather around the world, and there's probably been some, if not bad policy, I think there's difficult policy choices being made in regards to the energy pivot to green energy, and it's proving a difficult balancing act. There was really no wind in Europe for a couple of months, and they have quite a reliance on wind power. I think the UK relies about 25% of its energy demands come from wind, and if the wind's not blowing, that means they've got to turn to gas. Yep. And unfortunately, Europe was running super low gas inventories, I think in part because carbon pricing discourages gas production. So they've had to suck in a lot of gas from Russia in particular. So that's caused a sort of a super spike in gas prices. At the same time, look at China. It flooded in the coal pits, and it was a drought in the hydroelectric areas. So they've had an energy problem. At the same time, they've been waging a trade war with Australia in respect of not wanting to take our coal. So they've caught themselves in a bit of a self-inflicted vice as well. So I think some of that, it was a bit of a Murphy's Law, what could go wrong did go wrong. But I still think if you look at energy markets longer term, there's been no capital expenditure now in oil and gas, traditional oil and gas, for more than 7 years now. So I think the system will tighten up progressively, particularly if we get good growth over the next few years. So you will be more prone to these spikes when the weather doesn't behave itself or that sort of thing. And I think the trend for oil and gas prices is probably higher over the medium term. I don't think you're really looking at peak oil demand for another 10 years at least. Gas peak demand is probably a lot longer down the track. So from that perspective, I do think energy prices are going to be pretty buoyant on average over the next 5 years, possibly longer.
Yeah, it's interesting because it goes against the popular narrative in the market, which is that switch towards the energy transition. But it's almost the contrarian play that's sort of rolling out in front of us, isn't it?
Yeah, I think there is a bearish scenario for oil demand and even gas demand, but it's a 20, 30, possibly 40-year story. It's in the near term, I think it's actually perversely quite a bullish story for oil and gas markets.
And within the portfolios and the strategies that you're putting together, are you on the underlying equity exposures? Is that something that you're looking to get exposure to?
Yeah, we have been overweight the Aussie energy sector within our Aussie equity portfolio for some time now. Was not looking like a great call a few months ago, but it's come home with a bit of a wet sail in the last little while, and I still think that's the right way to be positioned over the next few years. We also like some of the big global integrated oil companies, massive free cash flows coming out of some of those companies. Look at something like Royal Dutch Shell generating a 16% free cash flow multiple this year. So from that perspective, yeah, we think energy is probably not a contrarian play now. It certainly was, but I think it's an interesting, counter sort of consensus play on a medium-term view.
Yeah, I think the thing people are trying to understand is, as you alluded to, how long can higher prices be sustained, and is the additional risk to the upside? But that's that lack of, I think you included a chart, and we can put it into the video, showing the lack of capex that's gone in because it's been disincentivised, and there's firms that don't want to be associated with that kind of investment.
Yeah, well, it started in 2014 and it collapsed last year, partly because of COVID, but I think also this intensification of the green energy pivot has really discouraged conventional capital spending in oil and gas.
I want to dig into a little bit about your latest asset allocation framework and some of the areas that you have, that you're tilting towards and those that you're tilting away from. I'm going to start with Australian equities because you've got a really long, deep background in that space, and it's also one of the parts of the global market that you're relatively optimistic. So talk me through a couple of reasons to be optimistic on the outlook for Australian shares.
Yeah, pretty simple thought process really. That's a sort of a 12-month call. Basically made that call in early October on the back of the prospective opening up of New South Wales and Victoria, which is a large chunk of the Aussie economy. So that reopening theme we thought would help the economy re-accelerate over the next year. That'd help profit growth, probably be supportive for the $8 as well. So on that basis, we did sort of want to play that reopening theme. I'd also say Australia is probably a little bit less sensitive to a rising bond yield than, say, the US market. And as I said, we think at the margin, the Aussie dollar, particularly against the US dollar, is probably going to be on the strong side over the next 6 to 12 months. So they're probably the three main reasons we're at least cyclically positive on Australia at the margin versus global equities.
And in terms of specific sectors or even strategies, so if you're talking about the asset allocation framework, have you got a preference for growth or value managers? And are there any particular sectors that you expect to, in the direct portfolios that you're doing, any areas where you expect to get some better performance?
Yeah, I guess maybe talking about global view first in terms of value versus growth. I'll probably once again have a cyclical bias for value, just in terms of being optimistic on the global economy, thinking that long rates will move up over the next 1 or 2 years. That probably puts a bit of a tailwind behind value, at least cyclically. So at the margin, we always hold a mixture of value and growth managers, but we're probably holding more value exposure than we would normally at the moment. In terms of the Aussie direct portfolio, we always try and hold a core of quality companies as sort of the ballast to the portfolio. So it's probably more quality rather than value and growth. So CSL, ResMed, Macquarie, Aristocrat, James Hardie, that 7 or 8 really high quality companies typically forms the base of our portfolio. Then we take some, I guess we call it opportunistic positions around that core. So we did have an overweight in banks last year and early this year. We pulled that back to a more neutral position, but we did put on an energy overweight about a year ago. We've kept that. And the other thing we try and do is utilise our small cap research expertise. So we always have a few interesting small cap ideas in the model portfolio. Telix is a small company on the sort of molecular cancer solution that we really like, and that's done really well for us. So we always have a few small cap ideas based on the Wilsons research in the portfolio as well.
bit more like a core satellite style approach to it.
Yeah.
In terms of, I guess, looking outside of the Australian equity allocation, which I think many of our viewers are comfortable with, you mentioned earlier that fixed income was not an area where you were finding value at the moment, particularly in bonds. And one of the ways that people have been looking to get some diversification or some uncorrelated returns away from equities is by introducing alternatives. Now, it's a broad church. There's a lot of different things that can sit under that alternatives bucket. But when I look through your return expectations behind the equity allocations, you had your highest return expectations coming out of that alternatives allocation within your portfolios. So maybe you could talk me through what sits under alternatives when you look at that bucket, and maybe picking an example of one of the ways that you're playing that, a strategy and a manager that gets past your filters. Yeah.
So for alternatives, it's really anything that's not a vanilla fixed interest or equity exposure. So it would include private equity, private debt, obviously hedge funds or absolute return funds, primarily equity, but also potentially fixed interest, unlisted property and unlisted infrastructure, and also potentially commodity investments, whether it be gold or some sort of basket of commodities there. That's sort of the mix for us in terms of alternatives. In terms of, I guess, something that cuts to the heart of what we're trying to achieve in alternatives, as you said, we're looking for uncorrelated sources of return. So what we were looking for this year was a genuine market neutral equity fund. So a fund that won't really behave like the equity market behaves, but genuinely uncorrelated risk and return. So I guess the holy grail is to find someone who can deliver equity-like returns, so let's call it 8, 9, 10% with no correlation to equities. So we put in Allium Market Neutral Fund. They've got a good track record of around that 10% total return with very low volatility, minimal drawdowns. They're actually up last March when markets were down 20, 30%. So we think if you can find a genuinely skillful market neutral fund, that's a good addition to a alternatives allocation. What were some of the tricks, or what are some of the processes that you go through in that search for the Holy Grail? How do you just give me a bit of an insight into the manager selection process? Yeah, well, I guess we call it 5 Ps. See if I can remember them. Performance, process. So we not just looking at the performance of funds, which is important, but also do we understand the process? Is it repeatable? Yeah. We like to get to know the people. Yeah. So that's the third P. How does it fit within the portfolio? So that's, I guess, the diversification or lack of correlation benefit that brings to the fund. And also the final one, price. I mean, how much does it cost us to access the manager into them? How are the incentives structured for the manager? So that's the 5 Ps we look at. David, if we were to wrap things up and I guess draw on some of the experience that you've had over your time at UBS and now at Wilsons, when it comes to putting together portfolios, what are some of the rules that you can leave with other people, or principles just about investing in general? Some of the big lessons that you pass on or that you hold close to yourself? Well, I think you do have to. It's a bit of a motherhood statement, but you do have to take a long-term view. There are times when things are going to look not so great, but you've got to take a medium to longer term view. Obviously, we always try and preserve capital, so we are running diversified multi-asset portfolios. But I think markets can get both excessively optimistic but also excessively pessimistic. So it is that medium to longer term view. Stick to your process and not get too captured up in the day-to-day pessimism or optimism, but particularly pessimism. Great. Well, listen, thanks very much for coming today. It's been a pleasure to catch up, and appreciate you sharing a bit of detail about how you're putting together portfolios at Wilsons. Great to talk to you, James. Thank you.